It's Thursday, May 2nd, and I'm recording this right after the market close. It's 1:19 p.m. right now. I'm going to talk about a kind of simple option strategy that you can try that's not just buying calls or puts or selling calls and puts. And we're going to get into the weeds just a little bit, but it's pretty executable. It's kind of risky, but it gives a decent reward if you guess it right. So it's worked for me a couple times, actually more like 5 times so far, and I haven't lost one yet. And but I'm very careful with placing them. So I'll show you that. But first, let me show you the account and see where I stand. So this is, oh, by the way, this is the video log that takes 30,000 to a million. We'll get there. All right. So we're going to the browser, and here we go. I'm sitting at 57,151. There hasn't been much advancement on the account. However, I did score an intraday high yesterday. It's right here. Where was it? Actually, it reached up until 57,900, but I'm down to 57,151 at the moment. The bigger movers, just real quick to go through it, is Apple went down a little bit, $138. It's not a huge loss though, as I have a call sold against my shares in Apple, and that got devalued all the way down to 20. So I only have $20 worth of liability here, which equals to a gain of $64 today, and overall $116 gain for that trade so far. And expires tomorrow, so it could expire worthless, which means I'll be getting the equivalent of another $20 in my pocket. So if that sounds a little bit complicated, don't worry, you'll get it eventually. So the rest of the account looks like this. EXK was down $24, another big move. So if you remember, I've been scaling into this stock now. My first purchase was 200 shares at $2.10. I'm waiting for it to drop down to $2 or lower until I buy another 200 shares. So I'm just being patient about that. Furthermore, we have the market staying flat. This was a big move here. C-SPAN actually moved all the way up to $10.69. I managed to sell 90 shares. Pretty straightforward move here, just selling shares. Right here at $10.58, closed down lower at $10.44. So it was a good move to sell thus far, those 90 shares. I also have 2 contracts sold against my the remaining shares, 200 shares of C-SPAN. So I'm basically out of this trade. That's what that means, okay? I'm out of it. C-SPAN is gone for me at this point, as long as it stays over $10, which it looks like it will be for the foreseeable future. And the exact date for my option calls is 5/17. So basically, I've promised to sell at $10 on 5/17, and it's above that price quite a bit right now. So those shares are going to be goners. The good part about this is that I'm still a big winner on this trade. My average entry cost is $7.34. You can see the total return right here for this holding minus the option. So probably around $550. All right. So that's about it. I think the big movers. I did enter into some option contracts. I sold a chemical put right here, which means that I'll be buying chemical at $10 and at 5/24, May 24th, if the price drops to 10 or below. And I also sold a call on chemical. It's pretty long, way out there. So we'll see if that pans out. It's a $12 call. So I'm just making money on time, basically. That's kind of what I'm doing. That's the strategy here. All right, that's it with the account. And now we're going to talk about the option strategy. So it's called a credit call spread or credit put spread. So what that means is that it's a really good way to take advantage of the time premium that options offer without having necessarily the collateral to back it up. But you're going to be risking a lot more than just having to buy or sell a specific stock at a certain time. You might lose all of your collateral if this trade doesn't work out for you. So this is what it's going to look like. All right, we're going to go into Apple. So here I'm going into Apple here, and I'm going to pick my trade options. You can do this on the phone as well. It just looks a little bit different. In order to do it on the phone, you just have to click the select button on the top right. I might show you later. So I'm going to go into a date that I desire, let's say May 10th, which is a little bit more than a week away. And let's say that I'm thinking Apple, there's no way it's going to go over $220. All right, what you want to look to is add the premiums. So you want to look at big premium differences, but you don't want to go so close to the actual strike price or actual spot price, because there's a high chance that it might get hit, and you don't want to risk that. You might lose all of your collateral. So what you want to do is pick something that's decently far away that also gives you money. So let's say 220 is a little bit unrealistic that it's going to reach by May 10th. It could. I'm not going to place this trade. I don't want to take that risk. But let's say you think it's not going to reach 220. So you're going to click the select button, or over here you're going to just let me go into browser show you. I haven't been in the browser, but no reduce. So here's what I'm talking about. So let's say you go into 220, you select the date, May 10th, right? Just like I said. And you look for big premium differences. So between 220 and 225, there's like an 8-cent difference. So that's, it gets bigger the closer you come to the spot price, but then it's really risky, right? This difference is 75 cents, or I'm sorry, 95 cents, but it's too close to the spot price, so it's going to get hit, by May 10th. So we're going to go over here, place this. It's a buy. I'm sorry, see, I clicked the wrong one. We want to sell a call if you think if we're bearish on it. So we're selling a 220 call, and then what we're going to do is buy, because we don't have enough collateral, right? Let's say I don't have the stocks. I don't have 100 stocks in order to promise to sell at 220. So what I'm going to do is I'm going to buy the next one up. All right, so I'm going to buy a call right here. You see the 222.5 call, and so that's going to help with the collateral. And I'm going to click continue. I'm going to say one contract, and over here it's going to tell you how much you're going to earn, the minimum credit that you're going to be earning from this trade if it pans out for you. If Apple does not reach 220 by May 10th, it's $7, and we can click review order, and over here will show you how much collateral you need, which is $250 in case Apple breaks through the $220 mark. And you can stack these contracts up. Let's say you have $1,000 in your account, right? You can go over here and you can make this into a 4, and now the trade looks like this. You're going to receive $28 on May 10th, which is like a little bit over a week, and you're risking $1,000 to do that. That sounds kind of steep, the risk, but you got to remember that there's a really low probability of the stock reaching $220 by May 10th. If you want to go super risky, what you can do is, let's uncheck these. Let's uncheck these trades. And so if you want to go super risky and collect a lot of premium, let's say you think that the stock's going to just not cross $210 by May 10th. And so you're going to sell that call, and you're going to buy the 212.5, and you can see how for 4 contracts now, I'm going to be receiving $384 for just $1,000 premium. All right, so almost $400, and I'm risking $1,000. But I have to be really convinced that the stock price is not going to go over 210. It's sitting at 209 at the moment. You can also do this the other way around. All right, so let's cancel these trades. And what I can do here is I can buy a put. Okay, I can go on the other side of the trade, and I can buy a put. So let's say I think that it's not gonna go below $200. All right, so I'm gonna buy a put, and I don't have the necessary collateral. Oh, oops, let me clear this. All right, do I have something unchecked here? Let me just clear this. I'm not sure why it's acting like that. All right, so here we go. Trade options. I can sell put, and I can go May 10th, just like we were earlier, because tomorrow is just not enough time to play out. Although you can do it. You can do it 1 day options. Okay, so I decided that I'm going to be selling a put for 200. So basically that's a promise that I'm going to be buying 100 stocks at $200, right? But I need $20,000 to do that, and I don't have it. So let's say I have 1,000 or something like that. So I'm going to sell the put so I can take advantage of the time decay, and I'm going to buy a put that's right above it here. All right. Oops, I'm sorry, below it. It works the other way around. So I'm going to buy the 197.5 put. I'm going to continue, and you can see how the minimum credit now is $20 if I enter one contract. And if we review it, you'll see that I need $250 collateral. It's a little bit similar. It's not the same for every stock. This price is calculated based on like volatility and things like that. Robinhood comes up with a collateral requirement. And so if I go to 4 contracts again, all right, let's say I cancel this and I go to 4 contracts, you'll see that I'm receiving $80 now, and it's pretty far away from the price, right? It's $209 away from the price versus $1 away from the price. So you can probably make more money that way. But let's say we get really close. Since it doesn't want to clear very well, let's just go back from the beginning. I click Apple, trade options. I sell put on May 10th. You can see how quickly we're doing this now. And let's say I go really close to the price, right? So I'll do I don't think, for example, that it's going to drop below $207.5. So I'll sell that put, and then I'll buy one just below it. And now I'm receiving 85, right? So if I do one contract, it's $85. Review the order for collateral $250, and I want to increase that to 4 contracts. Let's say I have $1,000. Now look, I'm receiving 340. It's a little bit less, but it's $2. It's $1.50 away from the price, and not just $1. So it's it's priced all right. There isn't really too big of a bias in either direction here for Apple at the moment. It appears so. So there you go, $340 with $1,000 risk. If you think that the price is not going to drop below $207.50 by May 10th. All right, so there we go. It's asking me to deposit money because I don't have enough for this. Everything is invested, and I don't have enough margin. I haven't activated enough margin to do it. I do have the ability to have a lot of margin. Apparently Robinhood now wants to give me up to $70,000 based on my profile of margin, but anyway, that's how you do it. It's called credit spread. Just be really careful. I would pick something really far out of the money, and just whenever you do it, be prepared to lose all of your collateral. It's not like selling regular options where if it doesn't work out for you, you get to collect at least agreed upon price stock or agreed upon price cash. It's not like that. All right, it's very risky. You could use all of it, lose all of it. And again, don't listen to me. I'm not a professional financial advisor, just a retail investor like you. Make sure you understand your risks and consult your financial advisor if you have one. If not, get one professional before you make moves like this, because you need to have everything you do be suitable for your risk tolerance. All right, with that said, I think that's enough for now. I know I jumbled up a little bit here and there, but I think I explained it fairly well. And I'm not doing redos, just one take, because I don't got time for it. I just don't. But hopefully you all are making millions out there in your portfolio and your account is doing better than mine. Let's beat that market. You know what I mean? All right, I think that's about it. Peace out.